Hello to everyone. Good morning, good afternoon, wherever you're located. My name is John Williams. I'm a director and head of our hydrogen expertise cluster. And I'm really pleased to welcome you all to our webinar today. It's the latest in a series of webinars that we've been doing over the last 2 years. Today, we're going to look at the future market for low carbon hydrogen. And this is based on a new hydrogen global trade flow model that we have developed. So without further ado, if we can move on to the next slide. Just our standard disclaimer, this will be sent around to everyone, made available later on. So we can just switch to the next slide and we can introduce everyone participating today. So really pleased today that we can present this webinar to you, and I'm joined by my colleagues Brendan Cronin, who's a director and head of our office in Dubai and the Middle East, and also Adel Ramadan, who is an analyst also in the Dubai office. And I will make the introductions, and then Brendan and Adel will guide you through most of the content today. So next slide, please. So before we start, you can ask questions throughout the webinar by using the question panel. We'll pick up questions at the end. We'll try and allow 10 minutes for questions. So if you post questions there, we will pick those up and we will get through as many as we can today. Also, the slide pack, the recording is going to be made available and emailed to everyone as soon as it's available following the presentation today. So next slide, please. So we'll just do a quick introduction to our involvement in hydrogen and the trade flow model before moving on to look in more detail at the model and the results of the modeling. So just very quickly, AFRY in general, across all the divisions, our ambition is to be the leading advisor to the hydrogen industry. And we provide advisory services and technical expertise across the whole value chain. And our aim is to be a one-stop shop for any of our clients at any point in their energy transition journey. And just some quick numbers about what we've been doing so far. Since the start of 2021, we've delivered over 80 projects looking at hydrogen and ammonia, methanol, etc. And this has been in over 30 countries, so we're active globally. In terms of the technical engineering aspects of what we do, we've been involved in projects with over 10 gigawatt of electrolyzer capacity, so some quite large and significant projects that we've been involved in. We cover the entire value chain from production to end use, and also cover ammonia and e-fuels as well. And we have over 50 experts that are involved in hydrogen projects globally, pretty much at any one time. So we have an extensive network of experts available to help all our clients answer some of these significant questions around hydrogen. Next slide, please. So the reason why we've developed this model is in order to try and understand where hydrogen export and import markets will emerge. And what we show here is announced project capacities and end users at various stages of development of project. And what you can see from here is there's significant project capacity being developed. It won't all make it through to FID and implementation, but you can see here the level of interest in hydrogen and other derivatives globally. And in particular, we see a lot of projects announced looking at industrial end use, transport, but also at exports. And we see some key regions emerging as potential export regions, focused on Middle East, North Africa, Australia, as well as South America, and particularly countries like Chile. So the reason we've developed this model is to try and understand the economics behind this growth or potential growth in the global hydrogen market. So today we'll present to you, as I said, the model, the assumptions, and the results. And I'd now like to hand over to Brendan Cronin, who will make a start on presenting the content.
Great, thank you, John. It's great to see so many people on the line today. I think we're very excited to present the model. It's something that we've been working on for over 6 months now, and I think it's a really good tool, and hopefully will be a tool that we'll be using a lot in future. Just a few points on the model and on this presentation. So it's a fundamentals model, and we're looking at the future demand for low carbon hydrogen and the future costs in different markets, and trying to optimize and find the least cost way of meeting future demand. It doesn't take account necessarily of national policies or targets. It's a pure fundamentals model in its current form. The scenario that we're showing today is what we call a kind of a what-if scenario. We haven't calibrated it to AFRY central scenario that many of you will be familiar with from M&A and our market analysis work more widely. It's a what-if scenario that is the scenario that we've designed at the moment, and we'll be refining it further. The results here are results we've looked at in quite a lot of detail, but they are our initial modeling results, and we do expect to evolve them further over time. So next slide, Adel. So the broad structure of the model, if you're familiar with AFRY's models and kind of economic models of the power sector or the energy sector more generally, the structure will be familiar to you. We have 31 modeled regions covering the entire market for low carbon hydrogen. We have a demand in each region, and then we have a supply investment costs in each region that define how much the cost of supply will be, and those investment costs are broken into green and blue hydrogen, which we'll talk about further. We also have the potential volumes that could be produced in each region, again split by blue and green. And then we have transport assumptions between regions. So we have how much capacity can flow between regions, and we have options for there to be pipeline transport and also ship-based transport. And then we have assumptions for the cost of that transport between regions, which is factored into the model's optimization. And then in terms of outputs of the model, we get a supply mix for each region, so how much blue and green each region is producing, and also how much each region is importing or exporting. We also get a market price for each region, and we'll describe, it's important to understand what that price represents, which we'll describe in more detail. And we also get obviously trade flows between regions, and then we can use the tool to understand potential revenue and potential profits that might be earned by different projects in that region. So next slide, Adel. So we'd like to be as transparent as possible about how the model works. I think it's kind of important to build confidence in the tool. So this goes into more detail on how we are defining the supply function. It's worth just saying briefly on the demand side, we have a fixed assumption on the future demand for low carbon hydrogen. So demand is not a function of price. It's just it's a fixed number for each region. And we'll describe how we formed that assumption in a later slide. The supply function is something we've talked about quite a lot, and we've looked at different forms. The current form of supply function, the supply is a function of two components. The first component is what is the price in that region compared to the levelized cost of hydrogen. So the higher the regional price compared to its cost of production, the more hydrogen it will produce. And obviously, if the price is less than the levelized cost, then that region would rationally not produce any hydrogen. But the more you increase the price in the region above the levelized cost of a project on a good site, the more supply you will get. And then the second important component is the resource. So a country might have a very good LCOH, but not have the land area to develop the renewables to supply the electrolysis. So we have developed assumptions on how much resource does each region have to produce low carbon hydrogen. So supply is obviously higher in regions which have more resource. So that is the broad structure of the supply function. The resource, we have split that into blue and green. We've sized the blue hydrogen potential resource based on current gas production. So we have looked at who are the major gas producers globally and formed an assumption on the size of the resource based on their current gas production. For green, we have we have sized the resource based on available land area, and that is a data set we've taken from the FAO, and we've used that available land area for each country to understand how much additional wind and solar could be deployed to support electrolysis. The price in each region is a variable that the model solves for, and it is a part of the optimization function. And this becomes just a technical moment. This is a bit more technical. We'll have a technical moment in the presentation just on the right-hand side for those of you that are interested in these kind of things. It's a linear optimization in Python. It has an objective function that it minimizes, and what the tool minimizes is the cost of meeting future demand for low carbon hydrogen. So we minimize the cost to consumers of meeting the requirement for low carbon hydrogen, which is a function of the production times the price in each region and the cost of moving hydrogen between regions. It's worth saying I'm using the terms hydrogen and low carbon hydrogen interchangeably. When I say hydrogen, I mean low carbon hydrogen. We are modeling here the market for low carbon hydrogen, so green and blue hydrogen. We're not modeling the existing market for gray hydrogen. So that is, under the assumption, what the assumption we've taken here is that is a separate market, but we're modeling essentially the market for blue and green hydrogen. And the tool assumes that they are interchangeable. And obviously, we could have a constraint where, maybe certain markets only accept green and they don't accept blue. That could be a future evolution of the model, but at the moment we're assuming that blue and green hydrogen are fully interchangeable, and therefore we have a single price for low carbon hydrogen. We have some constraints on the model which I won't go through, but they are very self-evident. But the result of the tool is that what the optimization does is moves hydrogen from places where it is cheap to produce to places where it is more expensive to produce, so that we get an overall balance and we're meeting demand in a least cost manner. Next slide, please, Adel. So just onto the scenario assumptions. So we wanted to take a public reference, at least for this first scenario that we've developed. And the IEA net zero roadmap is I think the best reference that we could think of. So we have the IEA net zero assumptions for future demand for low carbon hydrogen. The world isn't yet on the net zero roadmap, so what we've done is shift all of the demand back by 10 years. So we've taken the 2050 demand for low carbon hydrogen from the IEA net zero report, we've shifted that back to 2060, and then we've interpolated the intervening years. The IEA hasn't released regional demands. So what we've done is to split the global demand into regions based on each region's current total energy consumption, which is obviously an assumption, but we think it gives some reasonable results. And then what we've also done is for regions where they have very strong kind of policy support for low carbon hydrogen, we've given those before dividing the demand into regions based on total energy consumption. We applied a multiplier to some countries such as Japan, South Korea, such as certain countries in Europe. We have upgraded those so that they have a greater share of low carbon hydrogen because they have stronger announced policies. Again, it's just an assumption, but we feel that is reasonable because there's particularly Europe and Japan and Korea and other OECD states have very strong desire to use low carbon hydrogen and use it more quickly than the rest of the world. Next slide, please, Adel. So in hydrogen supply, essentially all markets can produce green hydrogen. So every region can produce green hydrogen, and then not all countries produce, or not all regions produce significant volumes of natural gas. So we have only certain regions can produce blue hydrogen, and you can see on the map which regions we have selected. So North America, Russia, Middle East, Australia, all major gas producers today, then they also have the potential to become major blue hydrogen producers. So we have a blue hydrogen resource for those regions, and that's something that's been something we've been working on. It's probably the most recent development that we've done, is to split out the blue and green hydrogen production and make sure that we can capture the ambitions of gas exporters today to move to blue hydrogen production in future. So I mean, so that's fine, Adel, we can stick with this slide. We have for each region 3 cost assumptions. So we have and it's worth saying that within each region we also assume. So first of all, let me describe this chart, and then I'll describe the second point on how it changes with production. So this chart shows the levelized cost of hydrogen. It shows the range between regions. So the bottom of the range being the cheapest region, the top of the range being the most expensive region. It shows the range for each of the 3 setups we have assumed. So we have a solar plus electrolysis option in each region. We have a wind plus electrolysis option in each region, and we have a blue hydrogen conventional steam methane reforming with CCS option in each region. And there is 3 different ways, therefore, of producing hydrogen. You can very definitely make the point that you can have hybrids, or you can have storage, and I think that's something that we will be looking at, but I think it's not going to dramatically change where a region sits on this spectrum and how it sits relative to other regions. So we think this is a very good first representation of levelized cost and the levelized cost range. The one thing that the model does is assume, this is the cost of the first project in each region. As further projects are built, the model it becomes more expensive to build an incremental project, and we reflect that. So good sites get used up first, and less attractive sites have to be developed, particularly for wind and solar. And we reflect that on the model. So this is the levelized cost for a project on a site with a good resource in that region. Do you go on to the next slide, Adel? So we have assumptions on the cost of moving hydrogen between regions, and again we want to use as transparent a source as possible and be transparent in our assumptions. So we have used this chart, which is actually from the European Commission, that shows the cost of moving hydrogen in different modes, by pipeline and for longer distances, to the conversion and reconversion from ammonia. And this is showing, and we reflect this for shorter distances and where a pipeline is available, for example, from North Africa into Europe or within Europe in particular. We reflect the pipeline costs of moving hydrogen, and then for longer distances, from the Middle East to Europe, or to Japan, or from Australia to South Korea, or from Chile to Europe, for example, we assume a cost that reflects the cost of conversion and reconversion from ammonia based on this chart, and the cost is a function of the distance between a key port in each of the regions. And obviously, the further the distance between 2 regions, the greater, therefore, the cost of moving hydrogen between those regions. Do you want to go on to the next slide, Adel? Yeah, actually, sorry, I should. We're at the end of the scenario assumption section, so I'll hand over now to Adel, who will take you through the initial results of the model. So over to you, Adel.
All right, thank you, Brendan. So yeah, thank you for giving a very thorough elaboration on what the model does and the assumptions that we did. So I'm going to present you the results that we've obtained after running the model, after settling the inputs. and the results should give us a good overview of what the future of the hydrogen industry will look like. So to begin with, the first output that the model produces is the hydrogen production in every region. As Brendan explained, so basically the model optimizes production and allocates production to each region based on several factors. So the Middle East and North Africa are set to become the largest hydrogen producers. And this is mainly due to several factors, one of them being the low production costs in these regions. And then there's the large availability of both resource, such as natural gas for blue hydrogen production, and land area for renewables deployment. And in that specific case, mostly solar PV and electrolysis. The same can be said regarding Australia, and that's why it's also a major contributor towards global hydrogen production. Second, we can analyze the production in the United States, in North America, including the United States and Canada, and China and Europe and UK. So hydrogen production in these regions is actually mainly driven by the high local hydrogen demand. And then finally, we have the remaining regions where they have a certain disadvantage when it comes to hydrogen production, whether it's the lack of available resources, land area, or the high production costs for hydrogen. So consequently, these regions don't produce as much. They generally produce enough hydrogen to meet local demand, but not actually participate in the export market. Looking more into detail onto how does the global low carbon hydrogen supply mix evolves over time. So first of all, we can see that the share of blue hydrogen decreases between 2030 and 2050, but still makes up around 1/3 of the global hydrogen supply mix. This is due to the fact that even by 2050, blue hydrogen remains competitive, remains economical to produce, and therefore proves to be essential in meeting global hydrogen demand at a low price. When it comes to green hydrogen, we notice that green hydrogen produced from solar and electrolysis setup specifically is mainly displacing the production, the blue hydrogen production, whereas hydrogen production from onshore wind and electrolysis setup maintains the same contribution towards meeting global demand, but still like producing in larger amounts. Moving on to another output from the model is actually hydrogen prices. So what you actually see here is hydrogen prices in hydrogen form, meaning that if hydrogen were to be procured or transported in ammonia, then the price is inclusive of the conversion and reconversion costs. So there are two main key messages that we can actually deduce from this chart. First one being the difference in price between exporting regions and importing regions. So these prices are actually reflective of the price at either the export hub or the import hub in each region. This big difference is due to two main factors. First one being, as we said before, the lower production costs in, let's say, Australia, Saudi Arabia, Chile, and Qatar, compared to other regions. And then there's the additional transportation cost, which is directly reflected in the price the importing regions hubs. So this additional transportation cost will automatically lead to higher prices in importing regions. The second thing that we can observe is the general downwards trend. So no matter which market we're looking at, whether it's exporting or importing, there's a decrease in hydrogen price over time. And this can be largely attributed to the decrease in capital expenditure for hydrogen production, which automatically drives down production costs. And as you can see, the curve kind of flattens as time moves on. This is mainly due to the fact that demand is increasing, and building new hydrogen production plants has to be moved to less favorable sites. So when we're talking about green hydrogen, the associated either like solar PV or onshore wind plants have to have lower capacity factors. So moving on to another set of outputs, so from the model. So who will be selling to who? First, let me just give you some information on how to read the graph. So the hydrogen flows are going from exporting markets to importing markets in the direction from left to right. What we can immediately see from these results is that the main exporters are actually going to be Australia, countries in the Middle East, and North Africa, in addition to other regions and countries that will also be contributing, but in smaller amounts, to the global export market, like Norway, Chile, Canada, CIS. So a key point where the model actually optimizes these flows is to minimize transportation costs, which, as we said before, are directly going to be reflected on the hydrogen prices in importing markets. So in order to minimize the overall price and reach like a global equilibrium where the prices are lowest everywhere, these flows were suggested by the model. And this is evident by looking, for instance, at Australia, which is exporting all of its excess production, let's call it, to Asian markets. The Middle East, including the GCC, is exporting both to Asian markets and to European markets. This is largely due to the geographical positioning of this region, allowing them to compete in both European markets and Asian markets. Canada and Chile exporting exclusively to the United States, and then regions in North Africa and Norway exporting exclusively to Europe. One more thing to note is, as you can notice in the bottom part of the chart, you see kind of intermediate stops going from the initial export point to the final, let's call it, consumption point. This is to kind of show, to highlight how the future hydrogen infrastructure network might look like in Europe, and what could be the technical requirements to actually, let's say, achieve these lowest possible prices, using a certain hydrogen infrastructure network. So finally, to answer the question of whether a hydrogen export market will actually exist, the model does not only suggest that an export market will exist, it sees that it will be actually necessary to meet global hydrogen demand at a lower, at the lowest price possible. So over the years, the global hydrogen export market will contribute by around 33% towards meeting global hydrogen demand. And not just that, the estimated export market size will actually be valued at around $85 billion by 2030, going up to almost $400 billion by 2060. So this indicates that the hydrogen industry will not only prove to be essential in contributing towards reaching certain environmental goals and tackling emissions. It also presents potential developers with huge economic opportunities. So that's all there is to say about the results for now. I'll hand it back to you, Brendan, so you can maybe summarize with some of the key findings that we went over.
Yeah, thanks. Thank you very much, Adel. So, I mean, just to say again, I think we're very excited about the model. I think it is, in our view, we haven't seen anything like this. You know, we've seen, point-to-point calculations of our, different supply curves of possible import costs for different countries, but we haven't, to our point, or in our views, seen a model that does a full global optimization and looks at the competitive landscape and tries to find what might be the optimal pattern of trade flows and prices in the future. So we are still thinking of ways, the model of how we can use the model and where it's going to be useful in future, and trying to understand what it tells us. These are some of our initial thoughts. The first thing that it shows is that, if we are going to move to net zero, that the market for low carbon hydrogen is going to expand dramatically. And as we get to 2050 and 2060, we're measuring numbers not in millions and billions, but even trillions of dollars, so $500 billion per year of a market size. The other thing that the model shows is that there is a rationale for international trade in low carbon hydrogen. A couple of the questions on that have come in are about trade, and someone's made the point that it is costly to move, and yes, it is costly to move, but also the variations in levelized costs between regions is also high. So there is sufficient variation to justify significant international trade in low carbon hydrogen, and the model shows that about 30% of the global consumption in the longer term is met by international trade. The model crystallizes. It's again this is in some ways obvious, but it's often useful to crystallize this in our minds, that the real important factor is, in determining the future prices, how quickly is electrolysis costs going to fall, and also blue hydrogen technology costs. So the speed of those cost declines is going to be a key influence on the future price driver. The other key important price driver, and Adel showed the variation between markets, and there's a big delta between importing markets and exporting markets, with importing markets having to pay a much higher price, and that's because transportation between markets is costly, and the price of the importing market needs to cover those transportation costs. So exporters and export projects need to consider how proximate they are to their destination market, because being close to your market is going to be an advantage. The other interesting thing about the future trajectory of prices that we see, prices fall over time, and that's largely driven by technology costs. In fact, it is driven by technology cost falls, but we still see a price decline even though the low carbon hydrogen demand expands by a factor of 5 between 2030 and 2050. So the demand is increasing, but we're still seeing technology costs managing to outweigh those price increases. And obviously that is very driven by the assumptions that we've made, but with using what we think are fair and our best assumptions, that is what we see. Just linked to international trade and the need, if there is going to be significant international trade, and I think this is something that is to the fore of the mind of people developing export projects today, is how are we going to structure those contracts, and how are the price indices going to evolve? So we will need, in the long run, low carbon hydrogen price indices, and I know some of the price reporting agencies have started that, but we need to get much more reliable price indices, and also contract structures, which I think is a real barrier to some of the export projects today, with developers wanting fixed prices and off-takers wanting prices that are linked to the current hydrogen price. So with the growth in international trade that we're seeing from the model, we're going to need to think a lot more and do a lot more work on actual commercial structures of projects. And I also mentioned certification as well in there as a key component. That is, I think, the end of the presentation. As I say, we're very excited about the tool. We definitely welcome, and we want to be transparent about the assumptions, about the structure. We definitely welcome people's comments and people's thoughts. So I'll hand back over to John, and we'll have, I think, time for Q&A before we wrap up.
Excellent, thank you, Brendan and Adel. So yes, we finished bang on time, so that's fantastic, which means we now have some time for Q&A. There have been questions coming in all the way through. We've answered some of them as we've gone along. A few of them were about the slide pack and recording. Will it be made available? Yes, it will. We'll send those out to people that registered later on today. If we don't get around to answering your question, then we will get back to you post-webinar. So I'm just going to take some of the questions now in the order that they arrived. So first of all, Brendan, perhaps you could elaborate a little bit on what does our optimization target? Is it the hydrogen cost or the overall energy cost?
So yes, just to be clear, so I think, as I said, the demand for low carbon hydrogen is taken as a given, taken as a fixed. So we are kind of just drawing the boundary there and taking a fixed hydrogen demand based at the moment on the IEA net zero scenario. We're not, for example, looking at the competing cost of hydrogen and EVs and road transport, or hydrogen and heat pumps in heat supply. We're just taking a fixed number for hydrogen. So it's not a least cost energy optimization. It's just given a certain demand for hydrogen, what is the least cost way of meeting that?
Okay, thank you. And then Adel, there are two questions here, and maybe you could answer these together. I saw another question coming in related to this. So what role do you see for, and there was a specific question on Ireland, but for Ireland and Northwest Europe in the future global trade of hydrogen. So what is the role of that region of Europe in the global trade?
Yeah, so basically under the assumptions that we've made and basically the supply function structure that Brendan presented, currently all countries in Europe, with the exception of Spain and Norway, are importers of hydrogen. And if they would need to ramp up production or even become exporters, then the price will naturally have to increase. So for the time being, these regions are, like the results suggest, that these regions will strictly be importers and will not actually be able to, let's say, export any of the, it might become different if we take into account the option for offshore wind, but for the time being, we're not. So yeah, this is where we stand for the time being.
Okay, so a number of countries in Europe produce their own hydrogen, but because the demand is higher, they become a net importer of hydrogen, and the cost of those imports help to set the price in those markets.
Exactly.
Excellent. Okay, Brendan, another one for you. So this is a really interesting one, I think. How does the model reflect current project announcements or policy announcements?
Yeah, so at the moment we haven't reflected any specific projects, because we haven't seen many, if any, large-scale hydrogen export, certainly export projects, or even low carbon projects for domestic use reach financial flows, as they do, and to the extent they're not already kind of, they're captured by the flows in the model, we would include them. For example, we would be able to, require that a certain volume of hydrogen might be exported from somewhere in the Middle East to somewhere in Europe, and we would have that as a fixed flow, depending on whether there's flexibility within the contract to redirect the flows. But currently, it's a pure kind of fundamentals model, and it doesn't reflect any specific project or policy announcements. But we will do and we can do going forward as projects kind of move through to financial flows, and if we feel that they would change the pattern of flows that we're representing.
Okay, thank you. So Adel, your turn. A question about the US. So will the US become a competitive exporter?
Again, I think similarly to the situation, like to the previous question, so like the situation in Western Europe. So our results currently suggest that the US will be like an importer, so it will be importing hydrogen to meet domestic demand. But it's interesting because as a standalone country, the US is actually the biggest producer of hydrogen. If we take back the segment, like if we look back at the segmentation of regions, but for the reason that the demand is just so high in the US, local production is just not enough to meet local demand, so they tend to be importing from other markets as well. And as we showed before, these markets will be Canada and Chile.
Okay, so again, it's a question of supply and demand. And
yeah.
Interesting that the US becomes the largest hydrogen market, the largest hydrogen producer, but might still be requiring some imports to enable that demand to be met. Okay.
Yep.
So time for a couple more questions. So back to Brendan. What's the demand forecast for green hydrogen, and how does green hydrogen's cost compete with grey hydrogen?
So just to kind of clarify that point, I think we're modeling here the market not for grey, so we're not modeling the existing demand for grey hydrogen. We're treating that as a separate kind of product, and that there's not interchange, that there may be some residual demand in the long term for grey hydrogen, but we're just modeling here the demand for low carbon hydrogen, so green or blue produced hydrogen. So there's not a representation of, say, the current grey hydrogen demand, but rather just a reflection of how quickly will that become. Once that demand moves to green and blue, then we incorporate it in the model, but we don't model an existing grey hydrogen market.
Okay, thank you. Okay, so one final question, and this is related obviously to the awful situation with Ukraine, Russia at the moment. Russia previously had stated some ambitions to be a hydrogen exporter to Europe, probably following the traditional gas pipeline routes. What have we assumed in the model about Russia and its ability to export hydrogen to Europe?
All right. So as Brenda mentioned earlier, like we've been working on this model for like close to 6 months now. And initially, so like before the current situation in Ukraine happened, we had a different set of results. But what we wanted to do now is to actually present results that reflect more closely the current global situation, and we therefore limited the or in other words restricted the amount that Russia can actually export. So for now, we just assume that Russia is not going to be able to export any of its energy products, and therefore these results, therefore we obtained the results that we showed you today. But I can confirm, like if we didn't restrict the export capacity for Russia, then Russia would be a major contributor towards and a major hydrogen producer towards meeting global hydrogen demand. So yeah, for the time being, we felt that these results make more sense in the current state of the world, and this is why we decided to show them.
But yeah, but Russia would be a major blue hydrogen exporter to Europe if we allowed it on a pure cost basis. But we have, I think we have constrained that capacity.
Okay, yep. Excellent, thank you. So I think we're just about out of time. You could just move on to the final slide. Thank you everyone for listening in today and for staying with us throughout the presentation. If you'd like any more information on the model, which we are now actively using in client projects, then please reach out to either myself, Brendan or Adel, and we'd be happy to talk to you in some more detail about the model or discuss how we might be able to use the model on some of your projects with some specific assumptions, etc. And just before we do close, as I mentioned at the start, this is the latest in a series of webinars. We have another webinar coming up in June, and this will be addressing the issue of the common mistakes made in evaluating renewable energy assets and how to avoid them. So a really interesting topic, I'm sure will be look forward to with interest by everyone on the call and lots of other people as well. The date is yet to be confirmed on that one, the date and time, but we expect it to be around mid-June. So please watch this space for further information. And finally, thank you again. Thank you to Brendan, thank you to Adel, and thank you to everyone for watching the webinar today. Thank you. Have the good rest of the day.
There's been quite a few questions come in. I've tried to respond to as many as I could, but if we didn't get around to it, apologies, and hopefully we continue the discussion by email or online. Okay.
All right. Thanks everyone. Thank you.